Today, we're talking about why you should hold cash, where you might consider keeping it, and then how to optimize your cash to get the most for your money. Let's start out with the first part. Why hold cash? Now, I try to invest as much of my money as I can in the stock market because I'm a huge fan of compound interest and I'm focused on building my wealth that way. I keep my long-term investments in a globally diversified portfolio at Wealthfront, where I have access to sophisticated strategies that help me maximize returns and minimize taxes. That said, the global market can be super volatile. You don't want to invest 100% of your cash savings if you might need some of that for short-term expenses. If all of your savings are in the market, you're putting your short-term finances at risk if the market goes down. Now, if you would have had a large expense invested in the market in early 2020, you would have been down almost 32% just by late March, a few months later. This would have put your ability to pay for this expense in jeopardy. And since we never know when the market will be down, it's important to keep some money in cash for 3 reasons. Number 1, regular expenses like mortgage, groceries, credit card bills. Number 2, emergency funds in case something large and unexpected comes up. Then number 3, savings for big expenses in the next few years like a down payment. Now, while I keep cash for regular expenses in my checking account where I don't earn much interest, I want to keep number 2 and number 3 somewhere where I can earn the most interest that I can. And until the beginning of 2020, there were many high yield savings accounts paying over 2% interest. That was possible because the effective federal funds rate, which is the average rate banks lend and borrow and funds to each other, was above 2% for all of 2019. That all changed in 2020 when the EFFR, effective federal funds rate, dropped to 0.05% and hasn't risen since, which meant that top online banks had to drop their rates and are now paying between 0.10 to 0.50% APY in their high yield savings accounts. That's not just a problem because we all want to be earning more, but it's a problem because inflation, the increase in prices, right, is on the rise, hitting its largest number since 1990 most recently. So where do you put cash? I don't want any restrictions on the account that I use to pay bills each month, so I'm okay with keeping that money in a low interest or no interest checking account. But where does the rest of that cash that you want some interest on go? Here are some options. High yield savings account. All right, yes, they might not pay enough interest to beat inflation this year, but they're FDIC insured and the safest place to put cash overall. I only keep a small amount in a few of these accounts to ensure the account isn't closed in hopes that interest rates rise again soon. Now, the bank with the best rates changes almost daily, and most comparison sites prioritize whoever pays them the most, let's be honest. 2 important things to keep in mind here is that an extra 0.1% on $10,000 is only $10 per year. So depending on your balance, it might be better to focus on whatever bank is the most convenient or offers the features you need. For example, Wealthfront makes it really fast and easy to transfer to my investment account from the cash account. And then number 2, you don't earn interest while your money is in transit. So chasing the best rate might actually hurt you. I prefer to keep my cash where I have the most flexibility and features to use. Now, crypto interest accounts. Many crypto products have popped up in the past few years. Many savers are turning to crypto interest accounts to store their cash. And for many of these products, the deposits are automatically converted to the USDC stablecoin and earns as much as 9% APY accrued daily and compounded monthly. If you're like me, you might wonder, how is this possible? They generate interest by lending out your deposits to borrowers, and because most large financial institutions aren't tied into this ecosystem to lend money, the rates are much higher. Now, these accounts are not FDIC insured, so I would consider it higher risk than a high interest savings account. Stablecoins also carry a high security, counterparty, and reserve risk that many traditional banks do not carry. Basically, if you keep your money in a traditional bank that is subject to the FDIC rules on reserves, they're required to keep a certain portion of your deposits in cash. They cannot lend out 100% of those funds. But with stablecoins, these institutions are not yet subject to this rule. In an ideal situation, the issuer of a stablecoin has enough reserves of that currency in cash or other highly liquid, safe investments to fully support the stablecoins. If it's any less than 100%, risk is introduced. However, despite multiple big crashes in the crypto markets, we haven't seen many of these platforms negatively impacted. All right, investing in, not holding cash. This is a controversial one, so hear me out. Almost all of my long-term investments are at Wealthfront, where I can take a portfolio line of credit against my portfolio at about 3.6%. Now, borrowing against your portfolio has a few major risks to call out. 1, your interest rate isn't fixed. It might go up at any time. And 2, if the value of your investments falls significantly, you may receive a margin call and have to repay some of the loan to meet your equity requirements. However, if the amount you need to borrow is a small fraction of your portfolio, it's much less likely that this is going to happen. So for short-term needs during a low interest rate environment where you have enough in your investment account that you need to borrow just a small percentage of your portfolio, this might be a viable alternative to cash. It's worth noting that the primary purpose of a portfolio line of credit is actually to further invest those funds, but not everyone uses those funds the same way. For For me, it's replaced holding a large emergency fund in cash because I can borrow from that portfolio. Here's an example. If you had $100,000 in a Wealthfront portfolio and borrowed $25,000, you wouldn't need to make a repayment unless your portfolio dropped 60% to $40,000, which I don't think has ever happened in my lifetime for a globally diversified passive index fund portfolio. All right, how much cash to hold? Using the 3 reasons I mentioned above at the beginning of this video, here's how much cash I hold for each reason. All right, for my regular expenses, I typically only keep about 2 months worth of my average monthly spending in cash in my regular checking account. I've found this to be a good baseline to use in case spending increases 1 month over the other. I also don't want to dip into my savings too often, so I'd rather just keep a nice buffer on my main spending account. As I pay for everything I can with a credit card, this amount should cover all spending on credit as well as your debit cash payments like your mortgage and utilities, things like that. However, in the last year, my spending has definitely fluctuated a lot, especially with ongoing home improvements and then some big trips we're trying to make up for some lost time, right? So now, our goal is to keep a large buffer, more like 4 to 5 months worth of spending in cash in my checking account. In a few months, I hope to get back to about 2 months worth and invest the extra cash. Now, emergency funds. I like to make sure I have access to at least 6 months worth of my average spending without selling my investments. However, as I mentioned earlier, I'm comfortable relying on a portfolio loan for emergencies, so I'm not currently holding much cash for this purpose. But rule of thumb is 3 to 6 months worth of spending in your emergency savings account. Lastly, short-term goals. This amount is entirely dependent on the major expenses that you have planned in the next 3 to 5 years. You don't want to invest funds in this time frame, so you want to set aside this cash in a checking or some kind of savings account. For me, we're still putting more money into our home and therefore rely upon this bucket for these purposes. All right, thanks again. This is Tony from Wealthfront. Take care.